in financial services, the virtual value chain, kind of what that information description of the assets is really changing in its character, its scale, and its power dynamics. Is that a fair?
I think it is. I think, again, if we look back, let's say 40 years,
Yeah.
the asset allocators were in a position where the asset managers were in short supply.
Yes.
So to get access to quality asset management, they were price takers. So
Yes.
they were at the mercy, if you like, of the asset managers. I
Sure.
think that has changed completely now, and the availability of asset managers has increased, and has put some of we're starting to see the power dynamic move back to the allocators,
Yes.
which accompanying their ability to be more interrogate, I suppose, to be able to interrogate the data better.
Sure.
They are holding more of that power over the asset managers by saying, look, you want our capital, you
Yes.
got to be able to prove to us that you are going to put it to the best use and deliver the best returns to us. And the definition of what that return is can it be just outperformance and growing the assets, or are they putting it into places where it's important to the asset allocator? So, and we'll talk a little bit later about ESG and where all of that's going, because I think that may be the next frontier in some of this.
Yeah, it's so interesting. I mean, it's just like it's almost what's happening to assets is the same that's happening to my eggs. Basically where they've been, and what are they doing and how are they treated. You know what I mean? And
yeah, and the price tag is high here from if you don't get this right. There was a recent survey by Casey Quirk, who does some work in the consulting space, and they were saying that less than or right around 23% of fund managers in the public market space are delivering excess returns. Which, I'll do the math for you, John. That means that close to 77% are not.
Yes,
that's a big number. And when they talk about I mentioned the cost pressures. When they talk about the cost pressures, those that are underperforming,
yes,
the cost pressure and the reduction in their ability to charge is 5 times higher than those that are outperforming.
Wow.
So they really are feeling that pressure. And then the flip side is those that consistently outperform will see 7% growth in revenue over, on an annual basis in the coming years. So again, the stakes are high, and the combined with the ability for the allocators to have better information and to be able to look more deeply into what their managers are doing, how they're doing it, and how they're providing alpha. It's not just about the return and what it looks like on the back end. They want to understand how did they do that, and how did they apply skill to deliver that.
Yeah, and it seems also that as you say, the IP, the intellectual value add, and then the other things, whether it's transaction services or information access or whatever, those seem to be more commoditized, or at least more competitive than they used to. Those all used to be kind of bundled together, the flow of the transactions, the data, the advice, all that other stuff. And now it seems like people are pulling apart different parts of that value proposition.
Yeah, and I think one of the other aspects of the democratization applies to the investment management side, because if what asset allocators are effectively buying is, let's call it alpha for now, then there may be other reasons they engage with particular managers, but let's just focus on the performance piece.
Yes.
If we're able to democratize the asset manager's ability, so really what is their investment skill, and not whether they have the scale to deliver all of those cost components, the transaction pieces, then we even the playing field, level the playing field for the asset managers. So those that have true skill but don't have the scale can compete on the performance